settling the retired partner at once by equal installment. Firm is going to settle the amount. Let's see. This is the problem. The following is the balance sheet of Gopi, Krishna and Ram on 31st 12/2015 who share profit and losses in the ratio of 4:2:1. There are three partners, Gopi, Krishna and Ram. They are sharing profit and losses in the ratio of 4:2:1. Capital account, Gopi 30,000, Krishna 20,000, Ram 15,000. So the total capital of the firm is 65,000. Sundry creditors 15,000, bills payable 2,000, general reserve 10,000. Goodwill 10,000, stock 15,000, sundry debtors 11,000, land and building 20,000, plant and machinery 26,500, motor vehicle 10,000. The total of the balance sheet is 92,500. These are all the additional information. On 31/12/2015, Gopi retired and the following arrangements were agreed upon. Number 1, goodwill of the firm is to be valued at rupees 24,000. The assets and liabilities are to be valued as under: stock 12,000 rupees, sundry debtors 10,500, land and building 22,600, plant and machinery 25,000, sundry creditors 14,000. Krishnan and Ram were to introduce rupees 20,000 and rupees 5,000 respectively into the business, and rupees 16,200 was to be paid to Gopi. The balance due to Gopi has to be paid in 3 equal installments annually together with interest at 9% per annum. Krishnan and Ram agreed not to retain goodwill in the books. Prepare evaluation account, capital account, Gopi loan account and balance sheet after the retirement of Gopi. So Gopi is retired. Goodwill of the firm at the time of retirement, admission at the time of retirement, the assets are revalued. So the goodwill is revalued at rupees to 24,000. These are all the assets and liabilities revaluation detail. Then Krishnan and Ram were to introduce rupees 20,000 and 5,000 respectively. Additional capital they bring. Okay. Krishnan brings 20,000, Ram brings 5,000 into the business, and 16,200 was to be paid to Gopi. Gopi immediately paid. Gopi is a retired partner. He was paid immediately 16,200. The balance due to Gopi has to be paid in 3 equal installments annually together with interest at 9% per annum. The balance amount, we have to open the capital account and we have to find out the capital account balance. That amount should be settled by the existing partner. So out of that total amount, they paid 16,200. Then they decided to pay the balance amount in 3 equal installments. The amount should be equal. Suppose the balance amount is 30,000 after the payment of 16,200. This has to be paid 10,000, first installment 10,000, second installment 10,000, third installment 10,000 with interest. They have to pay the interest. Usually interest is paid for unpaid balance of the amount. Okay. Interest is not one and the same. It will be reducing or it will be diminishing. Okay. The unpaid amount, for the unpaid amount, the partnership firm has to pay interest. The interest rate is 9% per annum. Krishnan and Ram agreed not to retain goodwill in the books. Prepare revaluation account, capital account, Gopi's loan account and balance sheet after the retirement of Gopi. Let's see the workings. Name of the partners. There are 3 partners in the partnership firm. They are called Gopi, Krishnan and Ram. Their profit sharing ratio is 4:2:1. Retiring partner is Gopi. New ratio of the remaining partner is 2:1. If nothing is given, we have to assume that they share the profit and losses in the same ratio. That is the same ratio means 2:1. Okay. Instead of that is Krishnan, the old share is 2/7. New share is 2/3. Like that, Raman, old share is 1/7. New share is 1/3. So they are gaining 2/7 and 2/3. So this is the gain which is enjoyed by the existing partner at the time of retirement of one partner. Okay. So the new ratio is 2:1. The gaining ratio is also 2:1. Okay. Then goodwill adjustment. Value of the goodwill in the book is 10,000. Revised value of goodwill is 24,000. Okay. How to deal goodwill? Let's see. As per AS 10, existing goodwill of, that is, how much is the existing goodwill? Value of existing goodwill is 10,000. As per A10, AS 10, existing goodwill rupees 10,000. This is the existing goodwill. Has been written off in the old ratio. Okay. So what is the old ratio? 4:2:1. Okay. Assuming that the goodwill is not purchased through a payment. Okay. As per AS 10 norms, only purchased goods will be appeared in the books. Okay. We are here assuming that the goodwill is not purchased, and so the goodwill which is in the book should be written off in the old ratio 4:2:1. So Gopi's capital account debtor 5,714, Krishnan capital account debtor 2,857, Ram's capital account debtor 1,429, to goodwill account 10,000. If we if we debit the total value of goodwill according to their old ratio, Gopi's share is 5,714. Then the Krishnan share is 2,857, and the Ram share is 1,429. See, as per the AS 10 norms, we are writing off the book goodwill which is in the book in the old ratio. Okay. Then the next step, we have to calculate Gopi's share of goodwill. Okay. The share of goodwill, the total value of goodwill is given, that is 24,000. Gopi's share is 4/7. So 24,000 into 4/7 is 13,714. Okay. So this is Gopi's share of goodwill. Gopi's share of goodwill adjusted by debiting Krishnan and Ram capital account in their gaining ratio 2:1. Okay. So his, that is Gopi's share in the new goodwill 13,714 is credited to his capital account after debiting the Krishnan and Ram capital account in their gaining ratio. Okay. So if we calculate the gaining ratio 2:1, that is this 13,714 should be debited to the old partners, the existing partner, the existing partner in the ratio of 2:1. So 13,714 into 2/3 is equal to 9,143. Then 13,714 into 1 by 3 is equal to 4,571. This is the goodwill treatment as per AS 10. Okay. First, we have to return off the goodwill which is in the balance sheet. Then we have to raise the Gopi's share of goodwill. Gopi's capital account should be credited, and the existing partners Krishnan capital account and Ram capital account should be debited according to their gaining ratio. This is the goodwill treatment. Then we have to pass journal entries for general reserve. Okay. So general reserve account data are 10,500 to Gopi's capital account, to Krishnan capital account, to Ram's capital account. Gopi is eligible, is entitled to get a share in general reserve because general reserve is a accumulated profit. Okay. Retiring partner has also got the share in the accumulated profit at the time of retirement because he has also contributed his time, maybe his effort and money. Okay. And so he is having the rights to get share in the general reserve and P&L account profit. Okay. So they are sharing the general reserve. The firm shares the amount of general reserve to all the partners, including the retiring partner, in the old ratio. So the old ratio of all the partner is 4:2:1. The general reserve amount is 10,500. So Gopi's share is 10,500 into 4 by 7, 6,000. Krishnan is 10,500 into 2 by 7, 3,000 rupees. Ram 10,500 into 1 by 7, 1,500 rupees. Old ratio. Next journal entry is revaluation account data to stock account, to provision for bad debts account, to plant and machinery account. So the assets value is reduced, liability is provision for bad debts is created. Here the plant and machinery value is reduced, and so revaluation account should be debited to stock account, to provision for bad debts account, to plant and machinery, 3,500, 1,500. Then land and building value is appreciated, sundry creditors value is decreased to revaluation account. Land and building account appreciated to the extent of 2,600, sundry creditors account reduced to the extent of 1,000, to revaluation account 3,600. And then next, Gopi's capital account data, the revaluation loss that should be transferred to partner's capital account. In this problem, we have got the revaluation loss, that is 1,400, that should be debited to partner's capital account to the extent of their profit sharing ratio. So Gopi's capital account debt are 800 rupees, Krishnan capital account debt are 400 rupees, Ram's capital account debt are 600 rupees. The revaluation to revaluation account is 1,400. Okay, the revaluation profit or losses should be transferred to all the partners' capital account in the, including the retiring partner in the old ratio. Then the next journal entry for additional capital. Cash account data to Krishnan capital account to Ram capital account. Krishnan brought 20,000, Raman brought 5,000. So the entry would be cash account data to Krishnan capital account to Ram capital account. Then Gopi capital account data. Gopi has to be settled 43,200. Then to cash 16,200. He is paid immediately 16,200. The balance amount is 27,000. That should be transferred to Gopi's loan account. Okay. So this is the way we have to pass journal entries for loan account as well as for the additional cash brought by the existing partners. This is the revaluation account. Stock. Stock book value is 15,000, revised value is 12,000. It is reduced to the extent of 3,000, so it should be debited. Sundry debtors, book value is 11,500, provision is created, and so it should come under the debit side. Plant and machinery, from 26,500, it has been reduced to 25,000, so 1,500 should be debited. Land and building is appreciated. From 20,000, it has been increased to 22,600, 2,600. By sundry creditors, 15,000. The book value of the sundry creditor is 15,000. It is reduced to 14,000. 1,000 rupees is the profit for the firm, because they have to settle 15,000. They agreed, the sundry creditors are agreed to get 14,000 instead of 15,000. Okay, that is the profit for the firm, and so it should be credited. So the total is 5,000 rupees. So the balance is 5,000 minus 3,600 is 1,400. That should be credited, that should be debited to the partner's capital account in the ratio of transfer to partner's capital account in the ratio of 4:2:1. That is 800, 400 and 200. This is the way to prepare revaluation account. Then the next step, we have to prepare the capital account of the partners. Okay. So balance, Gopi 30,000, Krishnan 20,000, Ram 15,000. General reserve, in the old profit sharing ratio, it should be shared 6,000, 3,000, 1,500. Then we have to transfer the realization loss. Gopi's realization loss is 800, Krishnan realization loss is 400, Ram's realization loss is 200. Then the goodwill treatment. Goodwill treatment. So first we have written off the existing goodwill in the old ratio. Okay. So the entry is Gopi's capital account debtor, Krishnan capital account debtor, Ram capital account debtor to goodwill account. Okay. So Gopi's capital account debtor 5,714. Krishnan capital account debtor 2,857. Ram's capital account debtor to goodwill 1,429. This is the treatment of goodwill that is entered in the capital account. We have written off here. This represents the goodwill written off. Okay. The existing value of the goodwill or existing goodwill which is in the balance sheet is written off among all the partners in their old ratio. Then we have ascertained the retiring partner share of goodwill. The retiring total goodwill of the firm is 24,000. Retiring partner share of goodwill is 4/7. That is 13,714. That 13,714 should be distributed among the existing partners, debited to the existing partners in their gaining ratio. Okay. So the entry is Krishnan capital account debtor 9,143, Ram capital account debtor 4,571 to Gopi's capital account 13,714. Okay. So here you see Krishnan capital account debtor, Gopi capital account is credited to the extent of 13,714. Here the Krishnan capital is debited to the extent of 9,143. Ram capital is debited to the extent of 4,571 rupees. Okay. This is the treatment of goodwill. Okay. Then the next one is the Krishnan and Ram brought cash 20,000 and 5,000 respectively. Further, the entry is cash account debtor to Krishnan capital account and Raman capital account. So Krishnan capital account is credited 20,000, Ram capital account is credited 5,000. Okay. So the total, now we can total the capital account of all the partners. First, let's close the retiring partner capital account, and we ascertain the amount that is to be paid to the retiring partner. Okay, how much amount has to be paid to the retiring partner? So the total of the Gopi's capital account is 49,714. Okay, 49,714. Here we have realization loss 800 rupees. Then goodwill is 5,714. Okay, then Gopi paid cash rupees 16,200, that is given in the problem. Okay, so from 49,714, if we deduct 800, 5,714 and 16,200, the balance amount is unpaid amount, that is to be transferred to the Gopi's loan account. So the balance amount is 27,000 rupees. That is transferred to loan account because the firm is decided to settle Gopi the remaining amount through installment, and so we have to transfer the unsettled amount to the loan account, and then we have to close the Krishnan and Ram account. Krishnan account is 43,000 and Raman account is 21,500. Okay, then from 43,000, if we deduct the realization loss 400, goodwill 2,857, Gopi's capital account 9,143, the balance amount is 30,600. That is Krishnan balance amount is 30,600. Then next we have to close the Ram account. Ram account capital balance is 21,500. Okay, from that 21,500, if we deduct realization loss 200, goodwill 1,429, Gopi's capital account 4,571, balance is 15,300. Okay, so this is the way to prepare capital account. Okay, first we have to transfer the balance, and then we have to transfer the general reserve, and then we have to transfer the realization loss, then goodwill, treatment of goodwill. Then here first we have written off the old value of goodwill, the existing goodwill, and then we have ascertained the value of new partner's share of goodwill, and that is debited to the old, that is the existing partners, and credited to the retiring partners. Okay, that is the goodwill treatment as per AS 10. Okay, then then we have to, then they bring cash to the extent of Krishnan brings 20,000 rupees, Ram brings 5,000 rupees. So first we have to close the Gopi's capital account. He is paid immediately 16,200. Okay, so that also has to be deducted from 49,714. Okay, this is the total 49,714. Okay, from 49,714, if we deduct 800, 5,714, 16,200, the balance amount should be transferred to the loan account. Here the total is 43,000. Here the total is 21,500. Okay, so the balance amount is 15,300. Okay, this is the style to prepare a capital account.
This is the capital, that is the installment amount calculation to find out the installment amount. Total capital balance is 43,200. Out of that 43,200, cash paid by Krishnan. Krishnan paid immediately 16,200. He settled 16,200 to Gopi. So the balance, remaining amount is 27,000, and the partnership firm agrees to settle the loan amount in 3 equal installment, and so it should be divided by 3. So each installment, the installment amount is 9,000 rupees. Okay, every year they have to pay 9,000 rupees with interest. They have to pay interest because he has to wait 3 more years to be settled. So for that, the firm has to pay interest. Along with the principal, the amount of interest has to be paid to settle the partners. Let's see how to prepare Gopi's loan account. This is Gopi's loan account. So by capital, 27,000 rupees. Okay, Gopi's capital is 27,000 on at the time of retirement or on the date of retirement. That is 31st 12/15, 2015. That has to be transferred to, that is the balance, closing balance is 27,000 at the end of the year. Then next year beginning 1/1/16, the opening balance, the loan amount is 27,000 rupees. They have to pay interest for 1 year. The rate of interest is 9%. So 27,000 into 9% is 2,430. So the total is 29,430. At the end of the year, that is 31st 12/16, the firm has to settle both principal as well as the interest. Interest amount is how much? 2,430. Equal installment amount is how much? 9,000. So the firm has to pay 11,430 rupees to Gopi. Okay, this is the first installment amount. 9,000 is the principal amount. 2,430 is the interest amount. The balance. How much is the balance? Total is 29,430. Out of that 29,430, 11,430 is settled. So the balance amount is 18,000. At the end of 31st 12/2016, the balance yet to be settled to Gopi is 18,000 rupees. Then the next year, 1/1/17, 2017, balance is 18,000 rupees. Interest we have to calculate. 18,000 into 9% is 1,620. So the balance amount is 19,000. Total amount is 19,620. It to be paid. So the equal installment amount is principal amount is loan amount which has to be settled by the firm to the Gopi is 9,000. And 1,620 is the interest. So totally the firm settled 10,620 rupees. Then the balance is 19,620. If we deduct 10,620 from 19,620, the balance is 9,000 rupees. That 9,000 rupees is the balance yet to be settled by the partnership firm on 31st 12/17. Then next year 1/1/18, 1st January 1890, the balance of loan account is 9,000 rupees. Interest 9%. 9,000 into 9% is 810. So the total is 9,810. They paid. They settled. The equal installment amount is 9,000. 810 is interest. So 9,810 is settled by the firm. So this is the style to prepare Gopi's loan account. Along with the amount the firm has to pay every year interest for the unpaid amount. They don't need to pay entire amount. Entire amount interest is 2,430 for 27,000 rupees. But it is reducing. It is every year it is diminishing because interest is usually given to a person for the unpaid amount. Okay. Hope you understand the loan account. Before preparing the balance sheet, first we have to prepare the bank account to know the balance of the bank. Okay. So, opening balance is nil. Then bank account data to Krishnan capital. Additional capital which is brought by Krishnan is 20,000. Additional capital which is brought by Ram is 5,000. Then Gopi is settled 16,200. The total of the debit side is 25,000. From that 25,000, if we deduct 16,200, the closing balance of the bank account or cash account is 8,800.
This is the balance sheet of Krishnan and Ram. They are the existing partner. Gopi is retired. So stock, revised value of stock should be entered here, 12,000. Sundry debtors 11,000 minus provision 500, 10,500. Land and building 22,600. Plant and machinery 25,000. Motor vehicle 10,000. Cash 8,800. Sundry creditors 14,000. Bills payable 2,000. Gopi's loan account 27,000. Capital account is 30,600 for Krishnan and Ram is 15,300 and so 45,900. The total of the balance sheet is 88,900. So how they are going to settle the loan, that we have seen in the previous slide. They are not settling the 27,000 rupees. Till the settlement of the retired partner, the amount is appeared in the balance sheet under the liability side. Okay. I showed the slide just to make you to understand how they are going to settle the Gopi. Okay. 3 years they are taking to settle the Gopi. Okay. Along with the interest, every year they have to settle the amount. But it is yet to be settled and so this amount should come under the liability side. Already we have calculated capital account of the existing partner, that is 30,600 and 15,300. So the total capital is 45,900. The balance sheet total is 88,900. This is the way to prepare balance sheet of the existing partner in the case of retirement. Hope you understand this concept.